Have you heard the news about the 40-year mortgages? And you're wondering if, well, maybe that's for you. Maybe a 40-year mortgage is exactly what you're looking for to help you buy a house. Well, I'm Professor Capko, and I'm going to help you analyze the numbers to properly compare a 30-year and a 40-year mortgage so you can decide what is best for you. And we're going to do so using my handy BA2 Plus calculator to exactly figure out how much each is going to cost you. But first, I want to say that I believe something great is going to happen for you today. And now, back to the video. If you're someone who finds it hard to calculate how much something's going to cost, or calculating the mortgage rate, or figuring out exactly how much your payments are, then give this video a thumbs up, because that way I'll know that you would like more videos like this to help you analyze financial decisions. Let's dive into this, and always give my disclaimer. This is not, nor is it intended to be, accounting advice, legal advice, financial advice, or real estate advice. I am showing you this for educational purposes only, so you can figure out for yourself what is best for you and your family. All right, let's look at this, and we're going to compare the 30-year and the 40-year mortgage. The FHA has recently approved 40-year mortgages for FHA loans. The idea being, with real estate and housing prices being so high right now and interest rates being high, that spreading the mortgage payment over 40 years instead of the 30-year mortgage would reduce the mortgage payment and perhaps make a home more affordable for families. So we're going to take a look at how much that savings actually is. For purposes of this, we're going to say that the amount borrowed to purchase the home is $400,000. This is more or less the average price of a home in the United States right now. So we're going to base it on that. And we're going to use a 7% interest rate, which is approximately what the interest rates are going right now for 30-year fixed loans. Now, in reality, oftentimes the rate for a longer term might be higher, just as usually a 30-year mortgage rate is higher than a 15-year mortgage rate. We could expect that the mortgage rate is going to be higher for 40-year mortgages. The interest rate might be higher because there's an added risk, an additional 10 years that the lender has to wait to collect their money. So that would indicate that we might have a higher interest rate, but I want to be able to compare apples to apples. So in this case, we're going to use the 7% for both mortgages. Fair enough? All right, let's go ahead and analyze the 30-year first. I'm going to write down 30-year so we can keep these straight. And we're going to find out what the payment is. All right, so I have done some videos about calculating a mortgage on a BA2 Plus and go into a little bit more detail. If you want to see that after this video, I've linked it up here for you, and you can take a look at that. Let's go ahead and turn it on. And the first thing I always do is make sure I clear out the time value of money. I clear out the work, and I hit the CEC button to clear out the screen. Let's enter our information. Our amount borrowed is going to be $400,000. So I'm going to start with that. And that is our present value. That's the present value of this loan right now. And I hit the PV and it shows you present value $400,000. Our interest rate is 7. I don't have to enter it as a decimal. I just go ahead and put in the 7. And because mortgages are always compounded monthly, I'm going to divide that by 12 because every month that gets compounded. So that is the interest rate per month, and I'm going to hit the I over Y button for that. Now for the number of payments, there's 12 payments in a year, and we're looking at 30 years. So that's going to be 360. I'm going to write that down here because that's going to become important again later when we're comparing these. So we have 360 is our number of payments. That's our N. Now all we need to do to figure out the actual payment is hit compute and PMT. And it tells us that our payment is $2,661 and if I round that, we'll say 21 cents. That's our payment for the 30-year loan. That's the monthly payment. It shows a negative because that's the money flowing out from you. I put in the house purchase price as a positive just because that was money coming to you to purchase the house. But you could reverse those. It's fine. Just know that that is the amount of your payment. Your payment will also include oftentimes an escrow for maybe your property insurance. It may include homeowners. It may have association. It may have property taxes. It may even also have a PMI, which is private mortgage insurance, if you put down less than 20%. So your payment may be more than this, but let's just use this as a basis because this is the principal and interest. That would be the amount of payment for our 30-year loan. Let's do the same thing. Now we're going to do it for the 40-year loan. I'm going to want to know the number of payments, and I want to know what each payment is. Now, a lot of this information is already in here, and I told you we're going to reuse it, but to let you know that everything's clear and we're doing this fairly, I'm going to clear out everything. Again, I'm going to clear out the time value of money. I'm going to clear out the work, and I'm going to clear the screen. Let's enter our information. 400,000 is the amount borrowed. That's our present value. Our interest rate will remain the same, 7 divided by 12, I over Y. And now our payments. We have 12 per year times 40 years. That's 480 payments. I'm going to write this down here because that's something we will look at again in a moment. We've got our N. Now all we need to know is what is our payment. So I hit compute and payment, and it tells us our payment is $2,485.73. That's quite a bit of savings. So we save some money per month. Our payment is lower than the 30-year payment, and that makes sense because it's spread out over 10 more years. How much difference is that? Well, let's take a look. Let's see the savings. We already have this as a negative, so all I need to do is add in the 30-year payment. It tells us our savings is $175.48, let's say 49 per month. That's a lot of savings. That is money that is in your pocket, and you could use it for anything. It could be gas, it could be food, you could put it in savings, maybe invest it. So that's how much you're saving per month. But is that the end of the inquiry? Well, not exactly. Let's see how much we're paying overall for this piece of property. Let's start again with our payment. Let's analyze the 30-year first and see how much we're paying over the life of the loan for this $400,000 home. Our payment for the 30-year is $2,661.21. I'm going to clear this out, and we're going to multiply that by the 360 payments that we make. So we have $2,661.21. I'm going to multiply that by 360, and that tells us over the life of this loan, over the 30 years, we pay $958,035.60. That's a lot of money to pay for a $400,000 home. So we're paying the principal amount of $400,000. Everything above that is interest. Let's see how much our interest is. So I'm going to subtract from that the $400,000, which was the original amount borrowed. So I've got that number in here already, so I can just subtract $400,000. We're paying interest of $558,035.60. Wow, that's a lot of interest to pay for this house. That's pure profit for your lender. Let's compare that to the 40-year. The 40-year, again, I'm going to clear this out. The payment is $202,485.73, and I'm going to multiply that by our 480 payments over the life of the 40-year loan. So 2,000, let's do this so you can see it, 2,485.73 times 480. Wow. That means we're paying $1,193,150.40 for this home. Same price, same amount borrowed, same exact interest rate. Let's subtract out our principal amount, the amount we borrowed. We only borrowed $400,000. That's all we borrowed. So I'm going to go ahead and here's the total amount. I'm going to subtract $400,000 from that to see how much is interest. Our interest is $793,150.40. That is a tremendous amount of interest. That's quite a lot. In fact, let's see how much different that is from how much we paid in the 30-year. So I'm going to take this amount of interest and I'm going to subtract it from the interest that we'd be paying in the 40-year loan. So I'm going to subtract the $558,035.60 from this number. So I'm going to go ahead and subtract it. 558,035.60. That means we pay an extra $235,114.80. That's the extra we're paying by getting a 40-year loan. That's a tremendous amount of money extra that we're paying. But wait, Professor Capko, we're saving $175.49 per month. What if we just save that in a cookie jar? Wouldn't that offset this extra we paid? Well, let's see. Let's see how that works out. We're saving $175.49 per month. And we said that we'd do that over the entire 480 payments because those payments never go up. So let's clear this out on the calculator and see what we get. We have $175.49 is our savings per month. We're going to multiply it by the 480 months of the loan. That is a total of $84,235.20. That's how much we would be saving monthly if we added that up. So we can subtract that from the $235,000. So if I subtract that for $84,235.20, I'm going to go ahead and put that as a negative here, and I'm going to add the $235,114.80. That means that there's still an overpayment of $150,879.60. That is a lot of extra money paid. And mind you, I'm being very generous with this for two reasons. Number one, I've calculated this $175.49 savings for all 480 payments. However, in the 30-year, we only have to make 360 payments. So there's 10 years of payments that we'd be payment free up here. I haven't even included that in here. We don't need to because this would just drive this number back this would drive this number back up. Don't forget also, we'd probably have a higher interest rate on the 40-year loan as well, which would drive this extra money out. Again, this is for educational purposes. You can do whatever you want that you think is best for your family. But for me, Professor Capko, I think this extra money, this $150,000, I think belongs in your pocket, not the bank's. Now, I'm sure there's going to be a lot of banks that are not happy with me for pointing this out, but I want to have educated consumers. If you're a subscriber to the Professor Capko channel, I'm going to take care of you. So if you have questions about this, or if I've missed anything, or if you want something else calculated, put it down in the comments below. And please subscribe to my channel and click that notification bell so you don't miss another video. Thank you.